We had a fairly large red day in the S&P last week, and one of the industries that got hit hard the most was in fact the big pharma and healthcare sector, as we can see double-digit decreases for the vast majority of stocks. Now we're going to cover that as well as some other parts of market updates. However, the focus of today's episode is going to be running through 8 undervalued dividend stocks with massive growth potential. As always, we'll look at each one in depth. We're also going to take a look at their earnings, projections moving forwards, how management's historical accuracy has been in the past, and we're going to focus on some key metrics, not just their dividend safety, but we also want to understand under dividend yield theory, under the forward P, are we getting more signals of severe undervaluation? And importantly, understand, do these companies have some very strong underlying financial metrics, as that is always important in the companies we want to add to our portfolio. On top of that, we're going to run every single one through our valuation model, getting to our intrinsic value, seeing the upside or massive upside that Wall Street see in each one over the next year, and also touch upon our margin of safety, running through if we see a 10, 20, 30, 40%, and give you our thoughts on each one of these 8 stocks today. Now, before we look at these stocks, just a quick reflection on the last few days in the market. The first one being the Fear and Greed Index now sits in neutral. Very interesting because the previous close this week was sitting at feed, so we can already see market sentiment has started to shift. Whether or not over the coming weeks we will move into fear or extreme fear, something we will keep an eye on, but remember the market can change very, very quickly, so definitely something that we would say just to be aware of. Now we have earnings season continuing, and the main one that should really be drawn to you is that Nvidia are reporting after the market close on Wednesday, something we will take a look at and digest their earnings report, so make sure you are subscribed and you have hit that bell notification. Now, a few points of information that have gone on that we do believe deserve your attention. The first one is that Trump did pick what they say as the vaccine skeptic RFK, and we have seen the effect that has had on the majority of the big pharma companies. The other one, not something we touch upon a lot on this channel, however we have seen Bitcoin go to all-time highs at around $93,000, and I would like to have your thoughts below as to whether or not this is something you do have as a little bit of exposure into your overall portfolio and something you do want us to cover on this channel. Other parts of information, well, Palantir continues to steamroll ahead. It is up around 11%. As we heard, they are now moving to the Nasdaq. This is a company that we have covered, one that we do believe to be overvalued, but the market does seem to like this a lot, and it is trading at a forward P well above 100, something just to bear in mind. The final piece of information is that Supermicro, again, one that we have covered. They are facing a deadline, as we have heard. Ernst & Young resigned as their auditors, and they had until Friday to essentially give information to the Nasdaq as to how they are going to verify their financial statements. We are still waiting on that, but as we can see, they are down around 85% since their peak in March, something that we will closely look at, as we know a lot of the community do have some exposure to this company. Now, the first company we're looking at today is AbbVie, which over the last 12 months is up around 20%. However, just over the last month, this is down around 15%, now trading at the mid to lower end of the 52-week range. We get a double buy rating from Seeking Alpha and Wall Street, although Quant do give this a hold. We can see right now the dividend yield sits around 3.9%, fairly attractive, and the forward P around 15.5. Now, if you're someone who has been holding this over the longer term, you would be up around 154%, a little bit higher if you reinvested your dividends. You wouldn't be too far off the S&P's performance in that same period. Now, happy to report that over the next 4 quarters, they are expecting growth to their EPS, although we do want to point out over the previous 4, they have a 50% track record. They have missed, unfortunately, 2 of the last 4 quarters, with the more recent one, Q3, being a beat. Now, management does anticipate growth to the full year accounts in December 2025, which will ultimately lower the forward P to around 13.98. Now, dividend safety, a score of 80, so it does look to be safe. We'll cover these 2 financial models shortly, and we do notice just last month they did increase that dividend by around 5.8%, which is above that minimum 4% that we discuss on this channel just to keep up in line with inflation. Few days ago, it was reaffirmed, November the 13th, in fact, the dividend is safe, which ultimately means a dividend cut for AbbVie is unlikely. Now, how do they perform in the last recession? That is some key metrics here, the 07-09 crash. Now, no dividend was paid, so we have no comparative data, but we can in fact see plus 10% recession sales, well above the average of the S&P, which comes in at negative 12. In terms of dividend growth, well, we can see here 5.8% as we mentioned, but over both the last 5 and the last 10 years, we can see some very strong increases, and ultimately they are a dividend king with more than 50 years of consecutively increasing the dividend. In fact, 100 years AbbVie have paid a dividend without a reduction. Now, when we take a look at this valuation model, over the last 12 months, we can see it has been trading above the blue tunnel, which indicates the expected fair price. However, right now we do sit around the midpoint, giving it reasonable valuation, but as always, we will conclude on our valuation model shortly for this company. Now, dividend yield theories, for those that don't know, tell us a company is undervalued when the current yield sits above the 5-year average. 3.98, not far off the 5-year rolling, so we would say here reasonable valuation. Forward P, however, 13.9 is above that 5-year 10.5, so this would be an overvaluation signal. When we compare it though, it does trade lower than the healthcare of 16.5, indicating that right now AbbVie is trading at a discount to the overall sector for healthcare. In terms of free cash flow, now this is one we will draw your attention to for this episode and in fact on the channel, as earnings is susceptible to manipulation by management through accounting. Below 50% is what we want to see for the biotech industry, and the main reason for this, where we have our rules, is because we want to ensure nice growth to the dividend on a year-on-year basis, pretty much straddling around that, as we can see, 48% in 2023, there or thereabouts over the next 12 months, so no worries whatsoever for AbbVie's dividend safety. We then move on to the free cash flow per share, where we want consistent growth over the longer term, something we actually see from AbbVie around 1.84 in 2014, pretty much 6 times into 2023 at 12.5, although we do expect over the next 12 months the free cash flow to remain fairly flat. In terms of sales growth, remember at the bare minimum 3 to 7%, 3 to 4 just to keep up in line with inflation. They've done very well over the long term. However, we do have to point out the drop of around 6% in 2023. And from a numerical basis, they've more than doubled their top line, 20 billion in 2014, 54 in 2023. Unfortunately, what we want to identify here is companies that return excess cash through those share buybacks to shareholders. What we can see, they've done the opposite. They've diluted your position, although marginally. Nonetheless, they have increased it from 2014 to the latest quarter's 1.77 billion. Then we get to ROIC, one of our most favored metrics on this channel. 10% or more, we can see for biotechs it sits at 25. Give us faith, management are able to effectively allocate their capital. And what we can see over the longer term, straddling around that, nice to note, 24% in 2023, something that investors and potential investors will love to know. Now on the operating margin, we're running through 8 companies today. We want to see not just above the minimum for their industry, but ideally we want to see operating efficiency, which is where we see increases over the longer term. Not something we get for AbbVie. Nonetheless, we still note above the minimum, and the free cash flow looking absolutely gorgeous, very high on a consistent basis. In fact, increasing 41 in 2023. Now the final metric, very important, the net debt to EBITDA. EBITDA referring to the earnings before interest, tax, depreciation, amortization. We want below 1.5 for biotechs, and the numbers that you are seeing below essentially tell us the number of years it will take the company to pay off all of their debt net of cash on hand. Remember, this metric correlates to both dividend safety and balance sheet strength. 1.85, so it is above in 2023, expected to go higher over the next 12 months to 2.28, so definitely one thing we'd keep an eye on. And with AbbVie, we can see capital allocation. We would like them to in fact start paying off their debt. That will help this number come down. Now we're going to jump into the valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Our intrinsic value of $195. How we got this, effectively we ran it through every single one of these models, and when we do our deeper dives we typically discuss inputs and outputs. Today we're going straight in, $195 average of these 4, and we always like to use a MOS on this channel where we start off with 10%, execute on that if it meets our 3 golden criteria. wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that in today's episode, a buy at around $176, then we keep going till it's near the current trading price at 15%, pretty much right there at 166. So for AbbVie, we believe 15% MOS, whereas Wall Street, their target price over the next year, higher than our intrinsic value at $207. They believe this company has 25%, and therefore we do believe this is a strong contender for one to consider in your portfolio. And for full disclosure, this is one that we also hold within our own portfolio too. As we go along these stocks today, give us your thoughts, buy, hold, or sell. And remember, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for AbbVie or any others. Now, today's episode is sponsored by Snowball, which is essentially a portfolio tracker, but does a lot more than just that. Face is very, very nice to see. In fact, it does split it out by sector, your own portfolio. It discusses the top gainers in the day, the top losers, for those that want to see the intricate details about where their portfolio is going, and also tells you about any news for your particular companies, not just the good ones, but also any that they do believe to be bearish indicators. We can also see the future payments of your dividend portfolio. You can also see your portfolio in terms of the dividend yield, the dividend growth, your total profit, and the split. So if you do want to see, actually, you know what, you have a riskier company, perhaps like Ultra Group, and it's around 4.76. Maybe you do want to cap underrated features as well, is the fact that you can see the S&P 500's performance against your own. Now, this is just a dummy portfolio, but for example, this portfolio, as we can see, has underperformed the S&P. In fact, it does say by around 30% just over the last year. You can also see the weighted average of your PE in the market, whether or not in fact it is a little bit too high and you want to consider adding companies to lower this overall, as well as the volatility. You can also see the split in terms of your dividend calendar. For example, we can see on the 15th, so that would have been yesterday, for those that had invested in Realty Income, you would have been paid out a dividend, as well as finding the dip in your own portfolio. For example, we have Adobe, which is down, also giving you references for those that like technicalities. And it doesn't just stop there. If we take a look at Johnson & Johnson, for example, there is a lot of information that we can take a look about this company, and it isn't just these numericals. We can take a look at their actual financial statements, where in fact, if we want to take a look at their income statement, we can see whether or not they are increasing their top line over the more recent period. If we want to do a quick health check, the same to be said on their balance sheet. Best thing is, you can also get a free trial below, so do click on that pinned comment and do take a look. We do believe this is a great tracker, and why not go ahead and try it out. The next dividend stock we have is PepsiCo. Now, this one not only down 5% over the last 12 months, but right now is trading at its 52-week low, $158. Over the last 10 years, not the greatest of performances, up 67%. We can in fact see all-time highs just under $200 more than 1 year ago. Now, in terms of ratings, all three, Seeking Alpha, Wall Street, and Quant, do give this a hold. And the yield, which sits around 3.3, we will come to show you, is very high in comparison to the average, as well as the forward P, while sitting at 20, is low compared to the 5-year. When we take a look at their earnings, well, they're anticipating growth quarter on quarter over the next year, and we can see historical forecasting actually looking absolutely beautiful, 100% track record, growth expected over the next full year, forward P therefore anticipated to come down to 19.11. We also get a dividend safety score of 93, massive severe undervaluation on both models, with a nice increase, 7.1% to the dividend in February this year. How do they perform in the last recession? Well, they increased the dividend, they had above average growth, and they massively outperformed the S&P, negative 35, S&P itself, negative 55. We also get consistent dividend increases, 7% over the last 5 years, 11% over the last 20, and they are officially a recent dividend king, 51 years of consecutively increasing that payout. So what about the valuation method on the forward PE? This company has been trading in severe undervaluation territory. Right now, the difference is quite significant, so definitely one we would say to consider, especially for dividend lovers. And we can see that yield is one of the highest over the last 5 years. In fact, it's only trumped by the increase that we saw around 3.6 during the COVID drop. 5-year average 2.84, and look at that forward PE, well below the 5-year rolling of 24. and we have to say it isn't too far off the consumer staples as well. So this is definitely one for serious consideration, and I would be interested in hearing your thoughts below. Now, one thing we have picked up on this company, we want to see below 70% for their free cash flow. Over the more recent period, it is above that, but always good to see over the next 12 months, this is something coming down to around 70% in line with what we want. Free cash flow, now understand the type of company this is, don't expect those growth from the tech. We do see it very inconsistent, but nice to see the growth from 2014 is there and expected with a massive jump there over the next 12 months. In terms of sales growth, well, 3 to 4% essentially at the bare minimum. That is what we see, although we can see on the trailing 12 month at 0%, indicating a lack of growth in 2024. When we have a look to their earnings report, they do cite, in fact, the weakening of the consumer environment being one of the issues in this year. Total sales, though, numerically around 50% growth from 2014 to 2023. And in terms of shares outstanding, they have done some share buybacks, but in fact, over the more recent period, it is very minimal and not something that management are currently prioritizing. Now, ROIC, no worries whatsoever, very consistent around the 19%. Remember, on this channel, we do sometimes pay a little bit of a premium for companies that have that consistency throughout. No operating efficiency on their margins, but again, straddling around that 16%, which is good to see. And their free cash flow, whilst it has been decreasing, still around that 7% minimum, so no red flag indicators that we do want to draw to your attention. And below 4 for consumer staples, that is what we see, down from the lows or the peak, in fact, of 2020 at 2.66, 2.03 in 23, 1.95 on a trailing 12 month, 1.83 over the next 12 months. So a very good sign. We are liking this company at the current point. Now, in terms of the intrinsic value, $171, it is unfortunately lower than Wall Street. They have it at 185 with upside of 17%. So in today's episode for PepsiCo, around the 155, so not far off. We do believe Pepsi, the dividend king, 10% MOS, 17% upside. Now, a lot of people will like this company. They will consider it. Others will think about growth and actually say, you know what, over the longer term, it may not give you that. But again, interested to hear your thoughts. We do believe at around a 10% margin of safety with the yield well over 3% now. Definitely one for serious consideration in that portfolio. Now, we also want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox where we essentially cover severely undervalued stocks that we believe deserve your attention, as well as what's gone on in the market over the last few days. So click below, sign up, and you can read straight away. You'll also be able to gain access to 40 undervalued stocks for the month of November. Lots of information, as well as the upside that Wall Street themselves see over the next year. And on top of that, you can grab a spreadsheet of 22 undervalued dividend stocks that Wall Street themselves believe have the most upside in the S&P 500 right now. So click below, sign up, and you can start reading straight away. We then move on to the defense company Lockheed Martin, where we get a double buy signal from Seeking Alpha on Wall Street, a hold from Quant. Right now it's pulled back from the 52-week high, sitting at the midpoint of that range. Yield at 2.5%. Forward P sitting around the 20 mark, and over the last year it is up around 20%, although when we look over the last month it is down around 12%. For those longer term shareholders, you would have outperformed the S&P up 185. In terms of growth, well, be aware over the next 4 quarters, they expect 2 of them to actually be an increase to the earnings per share, but they beat or outperformed massively over the last 4 quarters, so their historical forecasting accuracy is good and they have massively outperformed. So December 2025, if they do hit that EPS target, the forward P will come down to around 19.35. Now let's take a look essentially at the dividend safety. 84, very safe, great to see, and their dividend growth, disappointing, just above inflation at 4.8 in October this year. In terms of the last recession, while they increased the dividend, they had above average growth and they also marginally outperformed the S&P, negative 46. In terms of over both the last 5 and the last 20 years, they have increased the dividend very strongly. Again, one of the reasons why we were disappointed last month. They're also increasing those dividends for the last 21 years, 4 more years before they gain that dividend aristocrat status. So in terms of this valuation model, over the last 12 months, we can see it right now at the upper end of reasonable valuation. And when we look at dividend yield theory as well as the forward P, we get around reasonable valuation on the yield, although overvaluation as the forward P right now is above the 5-year 16.2. In terms of the sector comparative though, industrials is only marginally higher at 20.3. So when we look at the free cash flow payout, below 60% is what we want for essentially a blanket rule. That is what we get consistently, 52% over the next 12 months. No worries whatsoever. And we notice the free cash flow has more than doubled from 2014 to 2023, with a small increase anticipated over the next 12 months. In terms of sales growth, well, again, a little bit inconsistent, but still when we zoom out, it does look good. 2% a bit disappointing in 2023. We do in fact note on a trailing 12 month sitting at that 5% point. And when we zoom out from a numerical aspect, we can see around 80% growth, 40 billion to 68 in the more recent annual accounts. What they've also done here are those share buybacks. As we can see, it has been decreasing, 322 down to 241, so a very nice added bonus for investors, as we have mentioned, returning excess cash. ROIC, very, very strong, 36% in the more recent year. This is great to know. As we've mentioned many times, one of our most favored metrics when we do come to analyze companies that we want to add to the portfolio. Operating margin, very consistent around the 12%. Free cash flow looking good, consistent, but above that 5%, around 9 in 22 and 2023. Now, net debt to EBITDA below 3 is what we want to see. That is what we get pretty much from 2019 and expected to go lower over the next 12 months to 2.16. So good balance sheet, good dividend safety, as we saw in fact in the 80s, indicating very safe. Now, our intrinsic value, $608, is a little bit lower than Wall Street. They see 635, upside of 19%. And when we do it through the MOS calculation, what we find is it's not at the 15 percentage point just yet at 517, but Lockheed Martin around 10 to 15%, with, as we mentioned, Wall Street's 19% target. As always, give us your thoughts below, hold, buy, or sell. Then we move on to Micron Technology, where we get a strong buy rating from Wall Street, a double buy from Seeking Out from Quant. Trading towards its 52-week lows, we can see here the forward P at around 11 and the yield around 0.46. In terms of its performance, well, up 25% over the last year, marginally underperforming the S&P. Over the last 10 years, up around 190, marginally outperforming over the period. Now, in terms of their growth moving forwards, as we can see, that is expected in the coming quarters. In terms of their previous quarters, though, they have outperformed, some quite significantly, and massive growth is expected into August 2026, lowering the forward P to 7.73. Now, we get a borderline safe score at 60, and they haven't increased their dividend since 2022, something that we need to flag. And then when we take a look at their dividend safety, it was reaffirmed just a few days ago. Ultimately, what this means, there's a moderate risk of a dividend cut over a full economic cycle. Now, in the last recession, no dividend was paid, so no comparative data, but they did have below average growth, negative 18%. As we mentioned, no increase in the more recent period, but they've been increasing those dividends for the last 3 years. Now, when we take a look at the forward PE, what we can in fact see, some parts of the last 12 months severely overvalued, but right now it has entered that severe undervaluation, well below the lower end of that essential price. And then when we look at dividend yield theory, we can see an overvaluation signal, or reasonable, not too far off. However, the forward P at 10.8 is massively lower than the 5-year rolling and massively lower than the information technology. Some people could argue this company deserves to trade at the discount, but at this much of a discount is the question that does need to be asked. In terms of free cash flow payout, well, it does look very, very high in 2024. Nice to see coming down to 16% over the next 12 months. So hopefully we do finally get a dividend increase from Micron Technology. In terms of the free cash flow per share, now understand in this sector it is very cyclical, hence why we do get 2 of the last 10 years being negative, but a massive jump is anticipated over the next 12 months to 285 per share. Again, cyclicality is coming into the numbers. In fact, as we can see, 5 of the last 10 years have been negative, but good to report 2024 at 62% is a strong year for Micron Technology, and over the longer term, inconsistencies are shown, a nice jump from 23 to 2024. Now, shares outstanding, it does look a little bit confused. Some years they've done share buybacks, some years they've essentially issued shares, but we do notice a very marginal net share buyback over the last 10, very minimal, very trivial, not something we would say to rely on. In terms of ROIC, we want above 12%, very inconsistent, very cyclical shown through the numbers, 2% in 2024. Again, not the greatest that we do want to see, and that is why we always have that margin of safety element towards the end, or in fact part of the valuation process. Operating margin, again, we can see, as well as the free cash flow, lots of inconsistency, lots of cyclicality, and you ideally want to be buying these type of companies when they are out of favor, when they're towards the lower end of the cycle, and then riding them up towards the peak. In terms of net debt to EBITDA, though, good to see below 1.5 in 2024, and expected to go below that, in fact, even further over the next 12 months. So valuation, $138 for us. We can see Wall Street even higher. They see upside of 56%. And when we run it through the MOS calculation today, what we can in fact see is at the 30% level is where it sits right now. Micron Technology, ticker symbol MU, 30% MOS with 56% upside. We then move on to Novo Nordisk, a company that is down on the back of that RFK appointment. We can see up 5.5% over the last 12 months, just over the last month, down 15%. Although if you are a long-term shareholder, you would have massively outperformed the S&P, up 376%. Currently trading towards the lower end of the 52-week range. Buy rating from Wall Street, a double hold from Seeking Alpha and Quant, a forward yield 1.4%, forward P below 33, and we can in fact notice out of the next quarter they are expecting massive 25% growth to the EPS, although they have missed in one 75% track record with a nice jump anticipated to the EPS December 2025, lowering the forward P to 27.17. Nice dividend safety as well, very safe at 99. We'll discuss these models with a rapid dividend increase at 52% over the last full year. When we look at the key metrics, well, they increased the dividend, they had positive 6% sales, and they severely outperformed the S&P, negative 27%. And look at this lovely dividend growth. They've been increasing it 21% year on year over the last 20, and they're officially a dividend aristocrat with 25 plus years of increasing the dividend. Now, when we look at this valuation model based on the forward P, right now we can see quite a rare occasion, as pretty much over the last year we see severe overvaluation, trading below the expected lower end of the fair price. In terms of dividend yield theory, we do get a reasonable signal here, pretty much in line with the 5-year average. On the forward P, we get severe undervaluation, 26.8, below the 5-year rolling of 30.4, although we do see it significantly higher than healthcare at 16.5. Does this company deserve to trade at a premium? My response, yes. Again, question, how much of a premium is something we need to consider? In terms of the free cash flow payout, below 60%, something we see nearly every year. 51 over the next 12 months. So again, we would be surprised if we don't continue to get double-digit growth. We notice on the free cash flow payout pretty much tripled from 2014 to 2023. Another nice jump expected over the next 12 months. And when we get to the sales growth, while some years have been a lot better than others, over the longer term, much better than the minimum 3 to 7%. And we can see 26 on a trailing 12-month basis. We also notice when we zoom out, they have pretty much tripled their top line over the last 10, whilst also reducing those shares outstanding. Very nice to see, especially for a company that does have such a very high dividend growth. And then ROIC, absolutely phenomenal. Not one single complaint here. 72% in 2023, 64 on a trailing 12-month basis. Investors and potential investors will absolutely love to see that. Operating margin, phenomenal, yes, very minimal increases. Nonetheless, in the low 40s, very strong. The same to be said, an absolute free cash flow machine. And then we move on to the net debt to EBITDA. I mean, 0 over the last 12 months, 0 over the next 12 months. Wouldn't even take them one day to pay off all of their debt net of cash on hand. Now, our intrinsic value, $134, much lower than Wall Street. Their projected price, $155. They see upside of 52%. And when we run it through the calculation, what we can in fact see in today's episode is that it doesn't quite hit that 30% MOS. You are looking at the $101 mark, where it sits around today, 25% MOS, 52% upside, high quality company. But understand the bearish catalyst, RFK has now come in. He was an anti-vaxxer, and therefore there is a lot of pressure on this overall industry. Could it go lower? Will it now go back up? No one knows the question, which is always why we like to implement a margin of safety on this channel. We then move on to Thermo Fisher Scientific, double buy signal with a hold from Quant, trading towards the lower end of the 52-week range, a very small yield, 0.3%, a forward P at 25.6, not far off the S&P right now. Over the last 12 months, up 9%. Over the last 10 years, massive outperformance of the S&P, up 323%. We can also note, glorious to see, they have essentially saying that they will expect growth to the EPS year on year for the next 4 quarters, outperformed over the last 4 and expecting growth over the next full year, in turn lowering the forward P to 22.61. Now, dividend safety, 72 safe, undervaluation on dividend yield, undervaluation as we'll discuss here as well, and they increased the dividend double-digit rate in February this year. In terms of the last recession, no comparative data as they paid no dividend, above average recession sales and marginally outperformed the S&P. Love to see this, double-digit growth year on year over the last 5, 9% over the last 10 years, and they've been increasing those dividends for the last 6 years on a consecutive basis. In terms of the forward P, what we notice over the last month, it has been trading, in fact, over the last year towards the upper end of the expected fair price. Right now, it is sitting right at the lower end, which is why we would classify this on this model purely as an undervaluation signal. In fact, we get another undervaluation here, yield above 5 year. In fact, forward P below, so another continual undervaluation signals for TMO. Although we do notice, similar to Novo Nordisk, this company does trade at a premium to the overall healthcare market. So what about the free cash flow payout? I mean, that is incredibly low. One of the lowest we've seen on this channel, 8% in 23, 7% over the next 12 months. I mean, this company, if they wanted to, could increase that dividend at a much more rapid rate. Free cash flow also glorious to see here. In fact, more than 3 times from 2014 to 2023. Yes, we would have a little bit of a concern, a little bit stable over the last 4 years, but nice growth anticipated over the next 12 months to $22 per share. Now, their top line has been growing at a favorable rate, although we can see in 2023 a drop to 5%. But from a numerical perspective, when we do zoom out, more than doubled their top line, 17 billion 2014 to 43 in 2023. Shares outstanding, very inconsistent, marginal around 5% of total shares bought back from 2014. And when we get to the ROIC, remember around the 10% is what we want, pretty much on average year on year, sitting around that target. So what about their margins? Well, we do in fact notice consistency in both their operating side as well as their free cash flow. As we said, we love consistency. On top of that, well above the minimums, so always a very strong signal to note. Then we finally get to the net debt to EBITDA. Below 3 is what we want and what we get in the more recent period. 2.55 there or thereabouts over the next 12 months, so no worries whatsoever. And remember, that dividend payout was extremely low. Now, our intrinsic value at $619, well below Wall Street, uber bullish on this, 27% upside, $657 price target. And when we do run it through the MOS calculation, not at a 20% level just yet, we see around 15% MOS for TMO, upside of 27%. And as we always say, give us your thoughts below. We then move on to one of my favorites in the current market, ASML, the semiconductor giant. We have a double buy signal from Seeking Alpha from Wall Street, a hold from Quant. This one is trading at its 52-week low, down 3% over the last year. Over the last 10 years, massively outperformed the S&P, although we can see it is quite some way away from essentially its all-time high at $1,110. Now, the yield sits pretty much at the 1 percentage point with a forward P of 34.63. And when we take a look, double-digit, massive growth quarter on quarter over the next year and massive outperformance over the previous 4. 100% track record with growth continuing over the next full year, lowering the forward P to 27.8. Dividend safety also looks to be very safe, double undervaluation signal, and as we typically do mention, ASML 2024 had a very disappointing increase at only 4.8%. Now, we do want to make you aware they did cut the dividend during the previous recession. They had below average growth with pretty much an inline S&P return at negative 55, and they have increased those dividends at a double-digit rate over both the last 5 and 10 years. Again, one of the reasons why we were disappointed in July this year. They've been increasing those dividends for 14 years on a consecutive basis, and when we do get to essentially the forward P, we can see over the last 12 months, and in fact just over the last few months, this company is trading in severe undervaluation territory. That also extends to dividend yield theory as well as the forward PE, so double undervaluation, and it is now coming really low, in fact around the information technology sector, where before it was trading at a very superior premium. So what about their financial metrics? So the free cash flow payout to begin with, below 50% every single year, bar 2023. Positive to see though, coming down to 13 over the next 12 months. And their free cash flow, remember this is a cyclical industry, still increased over the long term, but has decreased over the previous 2 years. Massive growth expected though over the next 12 months into 2025. In terms of cyclicality, actually not really shown through their numbers. The more recent year was 30%. That is very good to see. And when we do zoom out, this company has been increasing their top line at a very rapid rate. In fact, quadruple, around 6 billion in 2014 to 28 in 2023. They've also bought back around 10% of those shares outstanding from 2014. So as we said, nice added bonus on top of a historical increase to the dividend at that double-digit rate. In terms of ROIC, no complaints whatsoever, well above 12% for the industry, in fact in the mid to upper 40s over the last few years. And the operating side, we do get some marginal operating efficiency, 26% in 2014, 33% in 2023, and free cash flow looking very good. So margins aren't an issue whatsoever for ASML. And then we get to the net debt to EBITDA. This is the best that you could see for this metric. 0 right across the board. 0 right across the board. Wouldn't even take them 1 day to pay off all of their debt net of cash on hand. Now our intrinsic value, unlike the previous companies we've looked at today, is actually higher than Wall Street, who do continually decrease. Essentially, Wall Street, when they see the price come down, they lower their forecast. When the price goes up, they'll revise their price upwards. So always take this with a pinch of salt. But they have $920. They believe 40% upside over the next year. And when we keep going on our essential margin of safety, what we in fact notice in today's episode for ASML, not at the 45% level yet, but we see 40% in terms of the MOS. Wall Street see 40% in terms of the upside. Give us your thoughts. We know a lot of people do like this company. Do you now consider this a buy? 40% MOS, 40% upside, or do you believe the bearish catalysts we have discussed do in fact deter this and make this a company that you need a larger margin of safety? We then move on to Elevance Health with a double buy rating from Wall Street, a hold from Quant. In fact, Wall Street would need a 4.5 to be a strong buy, so nearly at that point. This is trading right at the 52-week low, similar to ASML. We have a forward P at 12.3, a yield of 1.6%. Over the last year, down 13%. Over the last 10 years, outperformed the S&P even after the drop at 220%. In fact, just over the last month alone, this is down 18%. In terms of their growth, well, they expect out of the next 4 quarters, only 2 of them to be an increase, and they had a substantial miss in Q3, although the previous 3 they did beat. 75% track record, growth expected into December 2025, lowering the forward PE to 11.44. Now we do get a very safe dividend score with severe double undervaluation and a very, very attractive dividend increase at 10% in January this year. In terms of the last recession, well, no dividend, so no comparative. Above average growth, although they did marginally trail the S&P 61%. As we can see here, consistency is something we love, and the dividend increase at that rate, very attractive, 15% year on year over the last 10, with 12 years of consecutively increasing it. So in terms of the valuation model, we can in fact see over the last 12 months, more specifically over the last month, this company is now severely undervalued and looks like an incredible deal. And that is also reflected in the yield 1.63 above the 1.22, and the same to be said for the forward P. On top of that, also significantly lower than healthcare at 16.5. In terms of the free cash flow payout, consistently below 60%, 21 in 2023, 22 over the next 12 months. So we would be shocked if next year we don't get a very juicy double-digit increase. In terms of the free cash flow, we do like this growth. In fact, tripled from 2014 to 2023. Over the next 12 months, a marginal increase anticipated too. And their sales growth, no issues whatsoever, 9% in 2023, although we do anticipate a drop into 2024 based on the 3% on the trailing 12 month. In terms of the total sales, well, more than doubled over the period, and they've also done some share buybacks as well, very consistently, very marginal. Nonetheless, we do love this, especially in companies like ELV that do offer a very attractive dividend growth consistently. ROIC, again, no complaints, going from around 12% to 15%, looking very consistently strong, well above the minimum 10%. And the operating margin, we've discussed this many times, but whilst we do want above 12%, this is the industry norm around the 6 to 7% point. And the free cash flow, whilst we would like to see it higher, 4% in 2023 is only marginally lower. Something to bear in mind though, trailing 12 month down to 1%, something we do need, in fact, to keep our eye on. Similar to ASML, not even 1 or not even 0.01, meaning it wouldn't take them 1 day to pay off all of their debt net of cash on hand. Absolutely phenomenal balance sheet. Intrinsic value then, $530, actually not far off Wall Street, 534. They see 34% upside over the next year. And when we run it through the MOS calculation, in today's episode, what in fact we do see here is around a 25% MOS, around $398. So again, definitely one to consider in the overall portfolio. As always though, 25% MOS, 34% upside. Is this a buy, hold or sell? And give us your thoughts below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter by clicking on the pinned comment below, and also taking up that free trial on the Snowball Analytics tracker, one that we do love here as well. As always, we'll see you all in the next one and have a great day.